Most people treat the health savings account, the HSA, as a boring pass-through account. Money goes in tax-free, you get sick, money goes out to pay the doctor. It is basically just a debit card for your medical bills. And that is a massive financial mistake. Because if you know the rules, the HSA isn't actually just a medical account at all. It is the single most powerful investment vehicle in the entire United States tax code. Mathematically, it beats the 401k. It beats the Roth IRA. And if you use the strategy I'm about to show you, it can act as a stealth, super IRA that is completely tax-free forever. Welcome to Nerd Financial Path. Today, we're ignoring the standard advice. I'm going to show you the new 2026 eligibility rules, which just changed massively, the triple tax advantages, and the investing strategy that turns medical bills into tax-free wealth. Let's dive in. To understand why we love the HSA, we have to look at the taxes. Every other retirement account compromises somewhere. A traditional 401k gives you a tax break now, but you pay taxes later when you withdraw. A Roth IRA makes you pay taxes now, but you get tax-free growth later. The HSA is the only account that gives you the triple advantages. Number 1. The money goes in pre-tax, lowering your taxable income today. Number 2. You invest that money into the S&P 500, for example, and the dividends and capital gains are never taxed. Number 3. If you use the money for qualified medical expenses, you pay zero tax on the way out. But here is another point that most financial advisors miss. If you contribute to your HSA through payroll deduction at work, you also skip FICA taxes. That's Social Security and Medicare taxes. That is an instant 7.65% return on your money before you even invest a dime. You cannot do that with a 401k or an IRA. Before you get excited, we have to make sure you're actually allowed to open one. The rules have shifted slightly for 2026. To qualify, you must be enrolled in a high-deductible health plan. For 2026, the IRS defines that as a plan with a minimum deductible of $1,700 for yourself or $3,400 for a family. Here is the big update for 2026. The One Big Beautiful Bill Act effectively made almost all bronze and catastrophic marketplace plans HSA eligible starting this January. Previously, you had to hunt for specific HSA-eligible flags. Now, if you are self-employed or buying your own insurance on the exchange, your bronze plan almost certainly qualifies. However, watch out for the 3 instant disqualifiers. First, Medicare. If you are enrolled in any part of Medicare, Part A or B, you are out. Second, dependent status. If someone else claims you as a tax dependent, you are out. Third, and this is crucial, the spouse trap. If your spouse has a general purpose FSA at their job, that counts as other coverage for you, and it disqualifies you from opening an HSA. Make sure your spouse switches to a limited purpose FSA if you want to keep your HSA. If you pass that checklist, here is how much money you can stash away this year. The IRS bumped the numbers up for inflation again. For self-only coverage, you can now contribute $4,400. That is up $100 from last year. For family coverage, you can contribute $8,750. That is up $200. If you are 55 or older, you still get that extra $1,000 catch-up contribution. A quick warning, these limits are for the total contribution. If your employer gives you $500 for free as a perk, that counts toward the limit. Do the math so you don't over-contribute and get hit with a penalty. Now, here is the strategy that separates the optimizers from everyone else. It's called the Shoebox Strategy. The IRS has a very specific rule about HSAs. There is no statute of limitations on when you reimburse yourself. Let's say you go to the doctor today in 2026, and the bill is $200. Most people swipe their HSA card. Don't do that. Instead, pay that $200 with your regular credit card. Get your travel points or cash back. Leave the money inside the HSA invested in the market. Then, take a picture of the receipt, save it to a Google Drive folder or a physical shoebox, and forget about it. Because that $200 inside the HSA will grow. At an 8% return, in 20 years, that $200 becomes nearly $1,000. In the year 2046, you can take that receipt from 2026, submit it to your HSA provider, and pull out the original $200 completely tax-free to buy groceries, go on vacation, or whatever you want. But how should you actually invest the money? Unlike a 401k, you often have to manually choose your investments. Here are the 3 main strategies. Strategy 1 is the cash buffer. This is for people who are nervous about paying medical bills out of pocket. You keep your deductible amount in cash inside the HSA, so about $1,700 or $3,400 sitting in cash, and you only invest the excess above that. The pro is liquidity. The con is that cash is losing value to inflation. Strategy 2 is aggressive growth. This is what I do. Because the HSA has a 20 or 30-year time horizon if you're doing the shoebox method, you should treat it like a Roth IRA. I invest 100% of the funds into a low-cost S&P 500. We want maximum growth because the gains are tax-free. Strategy 3 is the asset location play. This is for the advanced optimizers. You might use your HSA to hold tax-inefficient assets, like REITs or high-yield bond funds. Normally, these assets pay high dividends that get taxed heavily every year in a regular brokerage account. But in an HSA, those dividends are tax-free. I hear the objection in the comments already, but what if I'm super healthy and I never have medical expenses? Is the money trapped? This is the ultimate safety net. Once you turn 65 years old, the HSA penalty completely disappears. If you have medical receipts, great, the money comes out tax-free. If you don't have receipts, you can withdraw the money for anything, a boat, a new car, rent, and you just pay standard income tax on it. At worst, the HSA becomes a traditional IRA after age 65. At best, it's a tax-free super fund. There is literally no downside compared to a 401k. So, here is your action plan for this week. Check your plan. Look at your summary of benefits. Does your deductible meet the $1,700 rule? Audit the spouse. Ensure your partner doesn't have a general-purpose FSA. 3. Choose your strategy. Decide if you want the cash buffer or if you're going 100% aggressive. I'm curious, which provider do you use for your HSA? I am using Optum Bank, but let me know in the comments who has the best fees right now. Thanks for watching. If you found this video helpful, please hit that subscribe button to help the channel grow.